Good afternoon, everyone. Thank you so much for joining today's webinar. And I think a lot of people are curious to know what will happen after this post-pandemic era for the Asia Pac markets. And today I'll share our thoughts from Eastspring. To recap a bit of last year's performance, it's always good to know what has happened in history. Last year, we had a huge outperformance coming from oil, Indian equities, US equities, and global equities. So what were the underperformers last year? Last year, we had China equity severely underperforming the rest of the markets, followed by gold and including Malaysian equities. This year, what has happened? On the next slide, you can see that there's a change of fortunes. As you can see on the table here, we can see that S&P, NASDAQ, and also the rest of the respective markets overall in the US have actually started to decline. So on a year-to-date basis, you can see the first two indices, which is the S&P and also the NASDAQ index, actually has declined close to 7 to 12%, just in the last 20 days of this month. On the flip side, we can actually see that in Asia, some of the markets have been quite resilient. So you have Hang Seng Index, which is up close to 6%. You got the China Index, which is close to up to 2.5%, and also ASEAN, which is pretty flat. So there's actually an ongoing rebalancing going on between fund flows, where the money is actually coming out from, coming from the developed markets like the US, and actually there's some fund flows going into emerging markets like Asia. Why is that happening? I think there's also two reasons. One of it is because the growth profile for the states, they are actually recovering, coming out from COVID. They're experiencing a strong demand push in terms of recovery. The economy is actually booming, and you can see here that overall forecast by IMF actually has shown that the overall this year's growth will actually be around 4.9%. And actually driven by advanced economies, which are actually going to grow at 4.5%. However, the stronger growth profile is actually coming from emerging markets, which is forecast to grow at 5.1% this year. And if we were to break it down further, we can actually see that where is this growth is coming from. So from the 5.1% in emerging markets, actually driven by a few key markets such as China, India, and ASEAN 5. And these three key markets are actually having much faster growth profiles compared to the developed markets. And I think that's why the reason there's partly investors are actually seeking shelter in the higher growth markets such as emerging markets this year. And when we talk about Asia, where is the next phase of growth for Asia? So we look at a few key trends here, and namely the biggest trend that we are seeing now is actually the digitalization of the economies of Southeast Asia and Asia. And here we can see that from the impact on the left-hand chart here, you can see that the impact to GDP from below 5% contribution to GDP, this overall impact is actually expected to rise to almost 15% by 2025. So there will be a huge impetus in terms of contribution coming from the digital sectors to Asia Pac's growth. And Asia, you can see on the left-hand chart here, is continuing to be the fastest growth region in 2022. When people were talking about inflation last year as transitory, I think the picture now is actually more muted. So we can see that in the inflation expectations actually started to rise. You can see that 10-year break-even inflation rates have actually started to rise quite significantly. And the reason being is because of the supply chain bottlenecks and the port congestion issues in the States. So there's a lot of dislocation in terms of supply chain moving from the east to the west. And actually that is actually started to ease, and we expect inflation expectations to come down again. So on the right-hand chart here, you can see that supply delivery times have started to shorten. So what that means is actually seeing that there's some shortening of time periods of moving of goods between the ports in the west, and actually that will actually elevate in terms of the inflation expectations actually currently quite high. While we look at the inflation figures, we also track energy prices. So energy prices actually has been rising. This year alone, we have seen in the last 20 days, oil prices actually gone up close to like 15% just in the last 20 days. We can see that who will benefit in Asia when oil prices are significantly at elevated levels. We will be countries like Indonesia and Malaysia, which are actually oil exporters. The bulk of the rest of the Asian Pac countries are actually oil importers, but nevertheless, I think in terms of the profile wise, they still have quite significant group profiles, and I think that will be able to sum up in terms of higher levels of inflation. And in terms of the management of inflation in this part of the region, we have seen that the Asian central banks have said that inflation targets for 2022 will be in line with targets. So we have actually seen that, despite the rise of inflation numbers coming in the West, but in Asia, we are still significantly lower compared to the global financial crisis back in 2008. And on why is that so? It's because we are coming up from pre-COVID pandemic levels, and we are still trying to narrow in terms of the negative output gap from pre-COVID. Okay, so I think now the key concern here everyone will have while having high levels of inflation will be how hawkish will be the Fed going into 2022. So I think here we've seen the Fed announcement that they're actually looking at possibly three rate hikes for 2022, and this is according to the Fed dot plots from Bloomberg. And we expect that it will be a gradual process, even though inflation numbers are quite elevated, especially in terms of the PCE indicator, which the Fed tracks in states, and also general CPI numbers in states, which are quite high at 7% currently. However, in terms of central banks in this part of the region, except for Korea, I think we will likely keep rates on hold unless severe changes between the Fed expectations in terms of rising rates becomes more hawkish. Would equities be affected if that's the case when rising inflation numbers come in and we have a hawkish rate cycle? Not necessary. So on this chart, we can actually show that moderate inflation hasn't really curbed stock gains in the past. So this is a chart and a research done by Alliance Bernstein. Over the course of the past 60 years or so, in terms of having inflation expectations between 0 to less than 6%, and they actually have a few observation periods. So in the context of this chart here, how to read this chart is basically when inflationary figures are less than 0, you probably can make like 5.2% on the S&P. If inflation figures start to rise between 0 to 2%, your returns for S&P will actually drop to 2.6%. And when inflation figures are between 2 to 4%, returns from stock S&P gains will actually amount to 2.7%. And as long as inflation numbers continue to creep up, your returns on equity gains will actually start to fall off. However, I think in terms of the inflation expectations by the Fed and also globally, I think it's continued to remain moderate. And expectation is that it would moderate second half of this year when we solve the supply chain issues and the port congestion issues globally. Okay, we have covered the monetary policy part of the equation. Now we are looking at fiscal policy equation where we can see that CAPEX is actually rising. So we have a few catalyst going on. We had a Biden infrastructure plan passed by Congress. It's a 1.2 trillion plan that will actually boost infrastructure. So that going into 2022, we expect that to actually cascade down to the economy. We also had the Build Back Better plan passed in Congress just recently. Also, it's actually a 2.2 trillion program, and I think that also boosts significantly in terms of the US growth profile on the fiscal side. And overall fiscal balance for all these developed markets remain not too tight, so it's still very good because we can continue to see the expansion programs being carried out in the respective markets in Europe, Japan, and US. Meanwhile, in Asia, the similar profile is actually happening. We have Asia ex-Japan, ex-China, CAPEX also recovering to the strongest record in recent cycles. This is even much higher compared to the GFC and the tech bubble cycle back in the past. And I think this is what is happening is actually a fall down effect from the developed markets where there's demand for more goods and services, and the part of the equation here where we actually supply these goods to the rest of the world. On the right-hand chart here also, we actually think that China's debt to GDP ratio will actually stabilize and should come down. And on this chart here, we see that the stabilization period from this year to next year to maintain the overall debt levels in China so that they can continue to grow. And with rising CAPEX expectations, we also believe that some of these catalysts will actually boil down to the respective countries. So earnings profile for these countries also start to rise. Where we have earnings expectations and earnings revisions ratios starting to factor in an improvement. And most likely we will see a huge improvement when banks benefit from increased capital expenditure and also environment where we have rising interest rates and also a low deposit ratio cost. Furthermore, we also expect the three segments of software, e-commerce, and internet to remain dominant in terms of driving growth in Asia. And particularly in terms of the segments where stronger growth will be coming from will be in the EV sector. So electrical vehicle manufacturers, upstream semiconductor players will actually benefit from the increased need for semiconductor goods in parts for EVs. And lastly, I think also small caps and manufacturing companies also benefit from the increased localizations required for the economy. And in Asia, we also have to monitor in terms of the economic profile where in the past, we were quite worried when tapering happens and would that actually have a negative impact on the profiles of Asia countries. I think times have changed, significantly changed. As you can see here, the circle of India and Indonesia, their current account balances have actually gone back to surpluses. So that's actually a positive. Compared to the periods of 2013, we can see that they had current account deficits, which it was quite detrimental during that period where you had a rising US dollar and the cost of goods were becoming more expensive, and they had actually a deficit in the economy. However, this time I think overall the situation has actually changed. And on the right-hand chart here, you can see that overall picture for in terms of the yield expectation, we are still having a much higher yield to provide a buffer against any rate hike expectations in the US. So overall, the yield expectations here are much higher. So I think overall expectations that we will not be so affected compared to the last few cycles when the Fed actually raised interest rates gradually. This chart here will also show where the MSCI Asia ex Japan perform relative versus the US markets and also against the dollar. So if you can see here, the dollar chart for the past 20 years have actually 4 episodes of rising US interest rates. So we had the Greenspan era where there was a huge rise in terms of the interest rates. Markets actually move in tandem during that period when and also we had also the global financial crisis during the period of 2008 and 2009, and subsequently the data tantrum and also the first rate hike after GFC. So in this context, actually we can actually have close to a 50-50 probability that the first 2 instances when dollar strength was actually quite significant, markets tend to underperform, but the other 2 periods where dollar strength actually depreciated, stock markets actually outperform in Asia. So I think in this context, it's still too early to call whether a stronger dollar would be actually detrimental to Asia Pac stock performance. While we are still moderately positive on equities, I think we need to have a tactical approach. So like I said earlier on, at the start of this year, we have actually seen US equities underperform. We also seen the Indian equities also start to underperform because of the expensive valuations. And actually, when in the rising interest rate environment, some of these valuations in this part of the region, it's much higher compared to Asia. So we think that we cannot rule out in terms of a reset, in terms of a correction coming from the States. So we have really seen that the market has really corrected for the Nasdaq close to 11%, 12% in the US. I think overall Asia could be quite shielded, although it depends on how fast this US dollar strength actually happened in the US. So I think overall we see that emerging markets were expected to fare better than developed markets. We advocate looking for tactical opportunities. So we in Eastspring, we also try to allocate the portfolio according to the catalyst that we like. So we like increased CAPEX, which will benefit materials and industrials. We are also looking at China because China has actually underperformed last year. And I think there's opportunity in China tech versus US tech due to the valuations, which is more expensive in the States. And also there's also room for a catch up for some of the value stocks in Asia. I will probably won't go through in detail on terms of the China's policy measures, but I think this year we have a few key points that we want to highlight. Is China is transiting its economy from overall to be more equal for their society. So they had this common prosperity theme which they played out last year. This year we also expect that to continue. However, I think the regulators are actually pledging to use taxation, social security, and transfer pricing to basically tackle illegal and illicit income. Overall, I think the regulation for fintech, big tech, I think is pretty much over. We have already seen the news flow actually started to die down. I think now most of the concerns are actually past us. This year, we have a few catalysts. We have a February event of the Beijing Olympics, and also the second half of the year where we have the China Party policy meeting. So where Xi Jinping will actually seek his re-election for the second term. In terms of China property slowdown, I think here we've already seen PBOC coming out to address the shortfall in the cash. They actually came out to inject huge amount of liquidity into the system end of last year, and also we also see that they have actually cut the lending rate early this year. So I think overall we can see that the government is actually putting in some measures to make sure that this China property sector does not fall into a systematic risk or a Lehman moment where they become too big to rescue. However, in this case, we can see that China has actually come out to provide ample support to the property sector. And I want to point out in the next chart, maybe you can see that overall in terms of the profile of property in the Chinese market, overall property levels are actually quite low. So the inventory levels in China remains quite well contained, which is good because we don't want to have a huge overhang of unsold property in China that will actually contribute to a lot of social issues to the economy and the government. However, in China, we have actually seen that overall property levels actually come up much healthier. Some of the corporates are actually much better off. Especially some of these state-owned enterprises which have better cash profiles. They meet the 3 red lines guidelines. Unfortunately, we know with the headline news of Evergrande, some of the news that came out, this recent picture has actually put a negative dent on share performance. But I think overall we have actually seen a recovery in terms of the property stocks in China. And this chart actually shows the recovery of what has happened in China this year. So we have a few names. We have China Overseas Land, China Resources Land, Longfor, all recording double-digit returns just in the last 19 days of this month. Well, obviously you can hear the news of Evergrande Group, Agile and Country Garden, but surprisingly, Evergrande Group this year also actually recovered quite nicely. It's up 8% this year. So I think in terms of the stock performance in this part of the region, despite the negative news coming from the States, there's still money to be made, and I think there's a lot of investors looking at all these cheap sectors such as property to invest for the near term. And Chinese regulatory cycle has been happening throughout the years, so it's nothing new. So every time we have a boom in the sector, there will be a crackdown in terms of having tighter regulatory control. So we have this in the mining, dairy products, liquor products, gaming, and drugs. So I think this is a very good thing that the Chinese government is actually putting check and balances to make sure that all these sectors are actually quite well regulated. So when we look over the course of history, China has actually continued to outperform emerging markets. So China remains the key dominant economy in emerging markets. And I think this trend has actually reflected quite well over history. However, I think we have to be cognizant that China is actually a big country which is normalizing growth. So it's actually expected to slow down. Hence, you will not see the huge outperformance in terms of the strong alphas that we used to get in the past. So, but I do have to advocate that China will continue to grow because the GDP numbers are still much higher than the mature markets. And in this context, we still expect that China returns would be much higher compared to emerging markets. And in terms of the context of valuations, we have seen that valuations actually normalized for China. Last year, we had the regulatory tightening cycle, and then China has actually come off under huge severe selling. And now the valuations actually come back to revert back to the mean. When we look at China in totality, we actually want to focus on selected sectors or segments of the economy. And what we like is actually the China A-share space. We think that the China A-share space is undervalued because there's a lot of new economic sectors which are actually doing well. And secondly, there's also the opening up of the China A market to investors. So as you can see, over the last few years, we have actually seen the index inclusion of China A getting larger and larger. So this is a good opportunity that the Chinese market is actually slowly opening up to global investors. And this market in place is actually having a lot of the so-called new economic sectors. So in terms of new economic sectors such as renewable energy, advanced manufacturing, and also semiconductor industries. And one good point is that these industries are actually don't really have a huge negative regulatory control, because the Chinese want to promote these businesses to become global champions. So making sure that they actually have the correct policies in place. So for example, previously they had the EV sector growing, they had actually subsidies for the EV sector. And I think some subsidies will actually be provided, for example, renewable energy, solar. And in the context of solar, I think they are trying to transit from thermal power to become more less reliant of thermal power. They'll definitely need to boost solar and wind power in terms of energy consumption. I'll probably skip this chart here because I just highlighted that the China A market is actually under-owned. So MSCI China is owned close to 26% by foreigners compared to 10% of A shares in China. And in terms of the industries, when we look at the industry breakdown for China, we can see that CSI 300 has mostly other sectors, and the one which is very heavy in internet technology, which was affected by the regulatory controls, was MSCI China, where close to 39% of their industries is heavily in the internet space. For China A shares, they had mostly most of the industrial names. That's why last year they actually were quite shielded. Actually, they were in the green compared to MSCI China, which actually dropped close to double-digit negative returns. And in terms of the overall demand for foreign A shares, I think it's remained robust. You can see that the chart here, there's always continuation of investors' interest into the northbound equity flows. Even though we had the regulatory shocks last year, stock markets in China continued to see inflows from foreign investors. So to conclude is to provide you a summary. I think in overall context of Asia, we think that Asia's macro stability is actually on a much better footing. So Asia has actually seen a gradual reopening following the lockdowns of COVID of last year. We have rising vaccination rates and less of a regulatory headwind to provide the growth impetus. I think overall, where we can see the growth coming from is actually coming from ASEAN, Korea, Taiwan, which actually benefit from a stronger US growth without being hurt by rising US rates. And definitely China. China is the elephant in the room here, which continues to grow, despite they definitely have to rejig the economy and reprioritize their initiatives in terms of growth. So we believe that China is doing the right thing here in terms of reallocating capital, addressing the property slowdown, the credit risk in the economy, and making sure that they become stronger from coming out from this economic cycle. And overall inflation is actually still manageable. So I think in terms of the context of inflation, we still bears monitoring. The risk that the supply chain disruption is still ongoing. There's a shortage of semiconductor products required for a lot of industries. And also the elevated energy prices is going to cause inflation numbers to remain high. Not only energy prices, we also look at metals and minings, and also soft commodity prices, which actually started to rally this year. So that's a key risk to monitor. Assuming if this overall picture does not change, it could actually present a risk for a more hawkish type of rising rate environment. However, in the near term, we expect that the Fed will actually go slow on the rate hike cycle after tapering. And in terms of the liquidity profile, we see that it still remains competitive in Asia. And what has happened, despite the pullback in the US, given the expensive valuations, we think that in Asia the valuations remain cheap. We think that there's money to be made. I already shared the earlier few decks of where the money actually flown through. Actually, has actually come back to Asia. We have seen a green outperformance coming back to Asia. And I think going into the second half of this year, we probably see once we move from the first rate hike in March in the States, we'll get a better picture of how well the Asia countries will stand against the rising rate environment, and in terms of how strong this dollar strength will go into the second half of 2022. However, I think the most important key note here is actually China is actually loosening its monetary policy, and I think they'll be providing supportive policies to the selected sectors to stimulate growth. So overall, I think it's going to be a good picture for Asia Pac stocks, and I think our house has a few number of funds that we have in the marketplace, and I think you'll be keen to talk to our agents to find out more about these funds. And with that, I'll end my presentation.
Yeah, hi, Mr. Tan. Yeah, thank you so much for your sharings today. Very insightful. And we do have a few questions flowing in. Let us move on to our Q&A session for now. Okay, just now the chart that you are showing, the inverse relationship between the inflation rate and S&P 500 return rate. So is this a good rule of thumbs? Also, is the inflation rate in the chart an expected or actual one?
Okay, that's a good question. So let me go back to the chart. So this inflation rate provided by is extracted from the Reserve Bank of South St. Louis and also the research done by Alex Bernstein. So it's actually an annualized inflation rate, so the real CPI inflation number that is being monitored by the central bank. So what has happened here? They actually track the periods of multiple periods. So you can see that some periods when inflation were less than 0%. Or near zero during that period of 13 observations, you had the highest gain of 5.2. And when you had inflations less than 6% or above 6%, you had 43 observations during that period, and you only made subpar performance in terms of S&P of 0.7%.
Okay, there's also another question coming in. Why Z-score of Malaysia is in negative territory?
Oh, because I think in terms of the Z-score, we haven't done really that well in terms of the so-called stock performance. Secondly, also a few negative catalysts. I think in terms of the fiscal balance of the country, in terms of the debt levels of the country, because we monitor a few different criteria, and also here looking at the standard deviation on a 12-year rolling basis, which is the price to book, is actually very expensive. So Malaysia is an expensive country with negative catalysts, and that's why the Z-score is negative.
Okay, thank you for the information. And also there's a few questions regarding bonds. Okay, so do you foresee Bank Negara Malaysia to raise our interest rate this year? And should the clients keep their MY bond fund?
In terms of the interest rate environment, I think it will be quite similar to where the Asian central banks around this region will actually try to position. So I think in the context of my presentation earlier on, I think central banks here will stay pat in terms of rising interest rates too quickly, because the official inflation number in Asia remains low. So I don't see, probably unless there's a situation where you have the Fed cycle turning more hawkish, so from 3 interest rate hikes to 4 interest rate hikes, to even I saw extreme cases of 6 interest rate hikes in 2022. That could see a situation where the dollar strength could be strengthening further. Then probably Bank Negara will have to intervene. But in the context of the last few interventions, I think Bank Negara is always proactive. So depending on how severe this inflation number is coming in, for now, I think inflation numbers is within manageable levels. As you can see on the chart here, it's still way below some of the previous cycles that we had. And lastly, also, I think in Malaysia, in the context as being an exporter of oil, oil prices remain elevated, quite high. It will actually benefit our country's coffer. So I think in terms of the overall well-being of the country, I think the country is still doing okay, fairly okay. So on the second question, whether to sell the bond fund, I think it's all depending on your expectations on returns. Okay, so if you are a bond investor and you are looking at, you have already made your money over the course of a few years period, and I think currently this environment where usually when the rising rate environment, bond prices tend to underperform. As you can see here, what's happening in the US with the rising rates, treasury rates, so sell off in the bond prices. So I think here we have to factor in what sort of asset class would you like to hold in your portfolio in terms of whether you are an aggressive investor or you're actually a balanced or even a passive investor with different mindsets in terms of expectation of return. So in this context, if you are having very high expectations of returns, probably holding a bond fund is not ideal in this environment.
All right, then besides this, one more bond questions. So since now the bond yield over the US is actually affected by the rising interest rate environment, and do you see this impact to our Malaysia bond fund as short-term shaky at the beginning of the rate hike, or is it have a longer-term impact for the next 3 to 5 years time?
Okay, so forecast going to 3 to 5 times is a bit difficult. I think it all depends. There are okay, in the context of going back to the question of whether you'll be affected by the negative sentiment or the issues of the hawkish Fed. Definitely, I think we can't run away from that, because ultimately the analogy here I will give, the Fed is like a cruise liner in the deep ocean. When they are moving the ship in the ocean, Malaysia, the rest of the region, Southeast Asia, Europe, Japan, China, we are all the ships next to it. They are the cruise liner. They are moving ahead with the cruise. And there'll be ripples in the ocean. The ripples in the ocean will actually cascade to the rest of the region. So in this context, I think how our interest rate path will actually be determined by the external events which is going to be happening in the States. So definitely, if you think, in my view, I think although I'm an equity investor, I prefer to put my money in stocks, because I think in the rising rate environment, even though we have high inflation, actually stocks tend to do much better over the course of history, and bond prices tend to underperform. So I think here we depends on how well Bank Negara will be able to contain in terms of the overall contagion effect if there was a really severe rise in the US dollar, and also the rise in the hawkish rate high cycle.
All right. So one question regarding the China region. Okay, while China now allows renewable energies sectors to grow, so can this client assumes that few years later, when time regulation may come in and limit the growth, just like how the IT sector is experiencing it over the China market right now?
Okay, so the IT sector, there's a few key issues that they were regulating. Is first of all was the data privacy. We had news flow of DT in the US listing, and then they had data leaks from it. Secondly, also the loophole with China listing their stocks, tech stocks in the US via the American depository route, the ADRs. China wasn't so happy about it, because they wanted some of these China champions to be listing in China itself, and also some of these Chinese companies were become too big. So I think overall the Chinese government wanted to provide certain check and balances to make sure that these companies actually fulfill the social agenda, which is common prosperity. What has happened is China's economy has grown so big, it's become very top heavy. So you have Forbes talking about the Forbes 100 richest people, 80% of 80 names come from China. And then in this case, Chinese companies like your Alibaba, Tencent are so big. There are a lot of wealth being kept by all these mega rich, ultra rich individuals. While, however, the middle part of the society is still left behind. So I think here China wants to make sure that the overall structure of the economy is olive shape, a shape of an olive where it's actually brown in the middle, so that everyone enjoys this prosperity. For renewable energies, I think it's going to be difficult for them to put in regulation, because they are trying to transit from being too dependent on coal thermal fire power plants, because you had 80% of their power generated by thermal coal, which is non-energy efficient, and also it's not carbon neutral. It's polluting the environment. They have to transit that to renewable energy. So renewable energy, we have solar, wind, and these two sectors are still fairly small. In terms of solar, it's only less than 100 megawatts. I think they're looking at 300 megawatts by 2030. So that in that context, I think they need to put in more subsidies, more infrastructure planning into that segments. And I don't see a huge key risk in terms of regulatory control. However, more likely is in terms of the subsidies. So for example, we have buying EV vehicles where the government will give you subsidies to buy a cheaper EV cars. But I think that side of subsidies will probably be removed for consumers.
All right, thank you, Mr. Tan, for your explanation on all the Q&As today. All right, the time is almost up. Thank you for sharing today. It's very insightful, and I hope the investor today do grab some knowledge from Mr. Tan. Back to you.
Thank you.
Okay.
Thank you for having me.
Thank you so much.